Hi, my name is Ben Shepard and I'm the editor of Global ETF Profits. There's been a huge debate over the past year or so as to whether or not the United States is going to enter a hyperinflationary cycle or a hyperdeflationary cycle. On the one side, the argument can be made that with all the quantitative easing that's been going on of late and all that excess cash knocking around the system, that really inflation rates have nowhere to go but up. On the flip side of that coin, the argument is that with unemployment so high, consumer demand so low, there's just not enough demand to create any sort of inflationary pressure. The Federal Open Market Committee recently released their policy statement from their most recent meeting, and clearly they're falling in with the deflationary crowd. While the statement was very measured with their announcement that they're going to roll the proceeds from their maturing bonds on their books into new intermediate term bonds, that's a pretty clear indication that they're very worried about downside price stability. I personally fall on the side of slight deflationary pressures. I agree with the take that unemployment's extremely high, consumer demand just isn't there, and if people aren't buying, there's no way to drive the prices up, particularly since the banks aren't lending. I personally think we'll see more inflationary steps taken by the Federal Reserve before everything's really said and done. That makes dividend-paying stocks and bonds extremely attractive at these levels. In our portfolio, Giannis and I currently have the iShares Barclays 3 to 7 year Treasury bonds. Ticker on that is IEI. Spider Gold Trust, ticker is GLD. Both of those are your traditional deflationary hedges. If prices are falling, gold and government bonds are going to hold their value, so at least you're not losing anything in the process. And in the case of the bonds, you're getting a little bit of yield along the way. Currently, IEI is yielding about 2.2%. But there are a few other deflationary hedges that you can add to your portfolio. One that I particularly like is the PowerShares High Yield Equity Dividend Achievers. The ticker on that is PEY. Right now it's yielding about 4.6%, primarily because the ETF's holdings are viewed by the market as being lower quality. I personally disagree with that assessment. The fund's holdings are heavily skewed to financials. They make up about a third of the portfolio, with utilities accounting for another third and consumer goods about 15%. And the individual names in the portfolio are companies like Altria Group, AT&T, Bank of Hawaii, GE. These are all companies that, while they clearly can come under pressure if the economy were to double dip or just hold steady from here, I don't see any huge risk of dividend cuts. All of the companies held in the fund's portfolio are cash flush. They have at least a 10-year history of maintaining, if not increasing, their dividends. I just don't see a whole lot of risk there. So with a 0.6% expense ratio, it's cheap enough that even if we don't see huge capital gains in the fund, the 4.6% yield is going to add a nice total return component to your portfolio while we wait and see which direction inflation ultimately moves. Another good bet, if you're a little bit less risk sensitive, is I would actually go a little further out in the maturity spectrum as far as the government bonds go. iShares Barclays 20-plus year Treasury bond, the ticker on that is TLT. It's got a ridiculously low expense ratio of 0.15%, and right now it's yielding around 3.5%. So in the event that interest rates rise, TLT is going to definitely get pinched, but I still feel like we're at least a year away from seeing any significant rate increases. So there's no reason you can't enjoy the slightly higher yield and the security that Treasury bonds offer. Kind of a periphery play on all of this is the iShares Barclays MBS bond. The ticker on that is MBB. Right now it's yielding about 3.7%. It's made up of longer dated mortgage-backed securities, primarily those bonds issued by Fannie Mae and Freddie Mac. So clearly in this environment, with foreclosure activity still being what it is, the employment situation still being pretty dreary, there is a fair amount of default risk in mortgage-backed securities. But the fund holds just a hugely diversified portfolio. So it would take a massive new wave of mortgage defaults before it really took a hit as far as the principal goes. Another kind of side benefit to owning this fund is I personally foresee the Treasury, the Federal Reserve reinstituting their program of purchasing mortgage-backed securities as a tool for keeping interest rates low on long-term fixed-rate mortgages, as well as a way of stimulating demand for mortgages. We've seen nice capital appreciation on MBS funds over the past 18 months or so, and I don't see any reason why that upward trajectory won't continue. So far this year it's up about 25%, but I think there's a lot more upside left for MBS securities. So there are 5 ways to hedge your portfolio against deflation. Again, my name is Ben Shepard and I'm the editor of Global ETF Profits.